Hey everyone! A massive and highly enthusiastic welcome back to the Noob Selling Options channel. If you're all about systematically extracting cash from the markets, well, you're exactly where you need to be. Go ahead and smash those like and subscribe buttons right now so we can keep growing this community together. Today, we've got an absolute monster of an explainer covering our entire Week 5 options playbook. We're going to break down exactly how we collected a very precise $1,669 in upfront premium for options expiring on July 24th, 2025. We've got a lot of incredibly high probability setups to unpack, so let's just dive right in.
Okay, let's dive into this. Here's our roadmap for today. We'll kick things off with the macro view in our Week 5 tally, move right into the ServiceNow barbell strategy, explore a deep value put on SK Hynix, and finally wrap up with a killer SpaceX volatility call.
All right, Section 1, the Week 5 tally, the macro view.
And this brilliantly illustrates the beauty of our systematic premium collection playbook. Just take a look at the official Week 5 board. We're running a full house of 9 different positions right now, a really healthy mix of cash-secured puts and covered calls across names like Dram, Palantir, Broadcom, the whole shebang. Altogether, these 9 contracts are generating exactly $1,669 in upfront cash flow. It's a highly diversified book, strictly designed to anchor our portfolio with steady yield while we wait for those perfect market opportunities.
Moving on to Section 2, ServiceNow, and what we call the barbell strategy.
So the absolute beauty of our position in ServiceNow, ticker symbol NOW, is that we own exactly 200 shares. And this setup lets us perfectly execute the barbell strategy. Instead of selling calls against our entire position, we're only selling a covered call for one single contract that covers 100 shares. This builds us the floor. We sell the 118 strike covered call to lock in a guaranteed $192 in upfront premium, right? But on the other side of that barbell, we've got the rocket. We deliberately leave our second block of 100 shares completely unhedged or naked. That way, if CEO Bill McDermott drops a monster AI update and the stock just explodes up to $120 or $124, those untouched shares capture literally 100% of that upside delta with absolutely zero friction. Seriously, it is the ultimate win-win scenario.
Now, to fully grasp why we're positioned like this, you have to look at what Wall Street is hunting for in this July 22 earnings print. The consensus is projecting around $3.92 to $3.93 billion in revenue, which, by the way, is a massive 22% year-over-year growth. But let's be real, the actual narrative here is AI monetization. The market is totally past the hype phase at this point. They want cold, hard execution. Analysts are laser-focused on customer adoption metrics for NOW's generative AI tool Now Assist to see if enterprise clients are actually paying up for those premium tiers. The other big catalyst? Margin pressure. Remember, last quarter the stock tumbled 18% because of some slight gross margin softness driven by integration costs from acquisitions like the Armis deal. So we really need to see those operating margins stabilize. Because of those high-stakes catalysts, the options market is pricing in a wild 11% projected one-day price swing right after earnings. That puts the potential trading range anywhere from $100 all the way up to $124. If we get a beat and pop scenario and the stock blasts past our $118 strike, hey, we gladly let our first 100 shares go at max profit while our naked shares just ride the rocket. But if we get a missing guidance cut and the stock drops, our $118 call expires completely worthless and we just pocket that full $192 premium as an automatic downside hedge. And that, folks, is the true power of the barbell.
All right, let's shift gears to Section 3, SK Hynix deep value puts. Now, what's really interesting here is how vividly the data exposes the market's mispricing once you strip out all that short-term cyclical noise. We're looking at a normalized 3 to 5 year long-term PEG ratio comparison. Basically, this measures valuation against expected earnings growth. Typically, a PEG ratio under 1.0 means you've got some strong structural undervaluation. Look at Micron Technology, an amazing franchise for sure, but it's sitting at a PEG of 0.86 to 0.95. Samsung is at 0.73 to 0.92. But SK Hynix, they are sitting at an incredibly compressed long-term PEG ratio of literally just 0.16 to 0.23. Talk about a massive margin of safety. They are easily beating out their competitors here.
And that insane valuation is exactly why we sold the $120 put on SK Hynix, yielding a super clean $207 in premium. We're basically telling the market, hey, we will happily take assignment on the highest margin, lowest PEG memory operator on the planet. Their structural leadership in high bandwidth memory, or HBM, is just an absolute moat. They lock in these customized, multi-year supply volumes with massive AI server and GPU titans, and that smooths out their cash flows way better than your standard commodity chip makers. If the stock dips and we get assigned, great. Our cost base is anchored on a core engine of the AI infrastructure layer at a severe multi-year discount. It is simply a bulletproof fundamental play.
Okay, rounding it out with Section 4, SpaceX, capitalizing on volatility.
So, SpaceX, trading under the ticker SPCX since that historic June IPO, recently took an after-hours hit following an aborted Starship test launch. We jumped on that near-term cyclical low and scooped up 100 shares at a really solid average cost of $124. But we don't just sit and wait, right? We put those shares to work immediately. By selling the $135 covered call expiring next week, we collect a hefty $167 premium. This is a highly disciplined mechanical move that instantly drops our net cost basis to $122.33, giving us an immediate built-in cushion against any extra downside from the headline noise.
So, the crucial point here is understanding the maximum profit scenario on a highly volatile asset like this. Wall Street has some wildly divergent price targets on SPCX, mostly driven by headlines around Starlink subscriber rollouts and SpaceX AI milestones. All of that creates massive implied volatility, which completely inflates those option premiums. If the stock just explodes to the upside past our strike, our shares get called away at $135. That means we capture $1,100 in capital gains, plus we keep the $167 premium. Add it up, and that's a $1,267 total return. You're looking at roughly a 10.2% ROI in a single week on a highly sensitive, high-beta growth engine. Not too shabby, right?
To bring this whole explainer full circle, let's break down our entire $1,669 Week 5 tally. Notice the balance we've got going on here. We're generating $1,041 from cash-secured puts, which is basically us getting paid to actively accumulate shares at a discount in names like SK Hynix, Broadcom, and Iron. And on the flip side, we're generating $628 from covered calls, harvesting yield from our existing equity upside in ServiceNow, Palantir, and SpaceX. It's just the perfect textbook execution of systematic premium collection.
And that wraps up our Week 5 Playbook Explainer. Now I really want to hear from you guys. How are you playing the ServiceNow earnings next week? Are you running a barbell strategy like us, or are you looking at entirely different strikes? Let me know down in the comments below. Thank you so much for hanging out with me today, and as always, please remember to hit that like button and subscribe to the Noob Selling Options channel so you never miss an update as we keep systematically collecting this premium week after week. See you in the next one.